Hello, my name is Corliss Mess, and these are my co-managers, Angelique Serrano, Sheena Roberts, and Christopher McCall. And we are presenting our business simulation game final presentation as the Bravo Footwear Company. So in this presentation, we will be discussing the different attributes that went into the decision-making process for these 10 years and also future recommendations for years 21 and 22 and implementations as it relates to future managers of this company, the do's and don'ts of competitive and financial stability in the future. So in today's presentation, we're going to discuss an overview of the financial performance of the company, followed by talking about the strategic vision that we implemented throughout these 10 years, followed by talking about the future performance of the company, also as it relates to the internet, wholesale, and private label competitive strategies, and see how that helped us to ultimately become second place winners. The production financial strategy will also be discussed, and also actions as it relates to how do we plan to outcompete our competition in the next 2 years. And finally, just some lessons that we learned along the way that we valuable to managers. So for this part of the presentation, we're going to be looking at the overall performance that our company experienced as it relates to our financials. And as a disclaimer for this specific slide, I would like to say that the focus on years 15 to 20, because that's where we emphasize a lot of our gains throughout this throughout the business simulation game. So specifically looking at net revenues, we can start there, and we can start to see that even for year 15 and 17, that we were able to make some significant gains of $500 million. Then next going to return on equity, and of course earnings per share, image rating, credit rating, and stock price. We can also see that just looking at the years 15 to 20 that we're able to see that we made significant gains. Also looking at prior to year 15, we did not pursue capacity gains, and so that also explains why we're not able to be successful prior to year 15. After year 15, once we had to start building capacity, we start utilizing that capacity to bridge our strategy and our.
My name is Sheena Roberts, and I will briefly talk about our strategic vision. The Bravo Footwear Company goal is to be the premier producer of quality footwear worldwide. A diversified product line will meet the cross-functional needs of athletes to achieve maximum performance levels. Our diversification creates value for customers, employees, and society, leaving a large global footprint. My co-managers and we decided to implement a high models, low cost strategy during the game. Therefore, using the low cost, low price strategy. In order to achieve this, we had to increase our capacity, so we had a large capacity. Also, the quality of our products, we lowered the SQ rating of our products slightly lower than our competitors so we can be cost efficient. Again, we offered more models than the other companies, and also we increased advertising to go with this strategy. We implemented best practices training to all our employees so they could provide the best customer service. And ultimately, we participated in corporate social responsibility. And therefore, we won the Corporate Social Responsibility Award in year 20.
Hi, this is Angelique Serrano. I'll be discussing the internet and wholesale market competitive strategies that we use throughout the game for our company. And we'll first be looking at the internet segment and specifically our market share by the end of the game, basically when we stop playing at year 20. So you can see that in all four of the regions that we sell our shoes, of course, North America, Europe, Africa, Asia Pacific, and Latin America, you'll see that B, which is represents our company, is basically where we wanted it to be in respect to what our overall competitive strategy was. So you can see that in each of the four regions, we managed to have a lot of product to sell at a reasonably low cost. The only competitor that we had that had a lower price was Company C all the way to the corner, but they also had less supply to sell, so they weren't a direct competitor in our case. So aside from where we're positioned in the market and showing what our market share was, we're also going to look at what our marketing expenses were through the presets in year 10, and then compared to how we ended up looking towards the end of the game at year 20. So in year 10, which is where the game started off, they split up the expenses where most of it, 77%, went to website maintenance, and there were no investments in celebrity endorsements, and then the remaining bit of marketing expenses went straight towards advertising. Whereas by the end of the game, we kind of went a similar route, but we took some of the we actually kind of took a little bit out of advertising and website maintenance and put it towards celebrity endorsements to help our overall image and basically gain more customers and make sure that we're selling all the product that we have to offer. So you'll see that technically website maintenance only went down 3% versus how it was preset for us, and then the remaining amount got split up between celebrity endorsements and advertising. We actually spent less on advertising because we ended up putting more of that towards celebrity endorsements, which is another form of advertising, of course. So now we'll be looking at the wholesale segment of our company, and we'll be looking again at market share on this slide. You can see the four regions and where our market share is in respect to our competitors and the footwear industry. So you'll see that we're positioned similar to how we were for internet, where we're still going along with our overall competitive strategy of high supply, or we have a lot of products to sell at a low cost, and you can see that we kind of maintain that throughout. And again, there are no direct competitors. Obviously, Company C went a similar route and still has a low cost of their products, but they offer so few that they can't be considered our direct competitor. So now we'll be looking at our wholesale marketing competitive strategy, and just basically looking at how the marketing expenses were split up initially before we actually started the game versus how we ended up towards the end of the game at year 20. So in terms of wholesale marketing expenses, there are more categories of how you can spend the money, and of course the preset in year 10, they did not spend any money, or there was no money spent on celebrity endorsements, and majority of the money is spent towards advertising. followed by retailer support, then rebate redemption, and online delivery at about the same amount, 10% of the marketing expenses budget. So towards the end of the game, we managed to shift everything a little bit. We spent almost 30% on online delivery, and we had a new expense of celebrity endorsements. That actually took up the other half of what would have been advertising budget back in year 10. Now 32% has gone to celebrity endorsements, which is just another form of advertising for our business. And we spent slightly more on rebate redemption and retailer support versus how we were in year 10. But overall, we basically just took the money out of our advertising spending and put it towards celebrity endorsements for the sake of the business. And we feel that it went very well in doing so. We still, our marketing expenses were to good use because the celebrity endorsements were still able to help us for selling our product in the wholesale market.
As for private label competitive strategy, our initial goal was to attract price conscious consumers looking for a good deal. We decided to pursue a moderate presence in North America to rid excess capacity. Um, our bid price in years 11 through 14 was $35, and it was pretty flat. Um, After year 14, um, additional capacity was purchased, and we decided to exit out of the private label um, business to refocus our efforts strictly on the wholesale market. Not competing in private label, but to operate at full capacity in our plants to reduce cost of overhead. That was our ultimate strategy in private label.
Hello, everyone. At this time, I will be talking about the strategy that we use as far as production for our team over the course of the game. Our strategy was simple. We wanted to produce a lot of models, but at the same time, stay low cost. And I think we achieved that. It was simple. Overtime was paid out to our employees, which helped us produce more models and increase our revenue over time. We also purchased capacity in North America, which also turned out to be good for us because it helped us once again produce more models because we had more capacity, more work area to produce in. So it helped us up our models of shoes and still stay within our low cost range, which we were trying to achieve. Hello, everyone. At this time, I will be talking about. Now I would like to talk about the finance strategy that my team employed during the course of the game. It was our goal as a company over the course of the game to generate enough revenue so that we could pay out small or large dividends to our stockholders. In year 11, we were able to achieve that goal. We had generated enough revenue to this point where we could pay out small dividends to our stockholders. We also purchased capacity in year 11 by use of a loan that we were able to establish when our credit rating was at its highest. We felt that this was the best time to establish our loan because our credit rating was at its highest, so we could maximize the use of our credit rating to get the loan that we needed to buy the capacity that we needed. Moving on to future strategy. It is our goal to continue to use the same strategy that we have, but at the same time be able to buy stock under this strategy and also grow our earnings per share by 5% for years 21 and 22, and also grow our stock price annually for years 21 and 22. We believe that if we continue to use this strategy and do what we're supposed to do financially, we'll be successful and at some point be able to pay out larger dividends to our stockholders. Now I would like
So let's take a look at table 2. For table 2, this is talking about the internet market as it relates to our competitors analysis. So we're looking at, so what we decided to do was to compare Bravo's Footwear, which is our company, and compare to 2 different companies within each region. Now, as you see that sometimes we're not, due to the strategy of our competitors, they may not have been able to come close to our scores, but we of course still wanted to make sure that we reflected everything that we was able to talk about in these next 3 tables. So starting from the internet market, you can see that Team A basically had an overall market share of over 18% in all 4 markets, in all 4 regions. And when it comes down to the internet strategy, before year 15, we actually emphasized internet marketing, the internet market as being where we want to spend the most of our time and resources in, because it's easier to implement and easier to have significant financial gains in the internet industry as we do not have a lot of overhead. But past year 15, we started to see that though the internet market can be a valuable asset to the overall financial position of the company, we decided to look elsewhere, and we decided, instead of using the internet market as our first alternative, we decided to use it as our second alternative. So you can even see that we still remain competitive even for the North American region, though we were not above Group A, which is all about footwear. We still was able to compete even above Group G, which happens to be galactic footwear. So for the next couple of slides, we're going to be talking about just the significant points that it relates to how we was able to successfully compete within these other regions, and of course within the different markets. So for table 3, we're looking at the wholesale market. So prior to year 15, we decided to not to focus so much on the wholesale market, because as we stated in the previous slide, that the internet market was our primary position. However, after year 15, we started to not only buy capacity but to build capacity in the 2 other different regions in the game, which happens to be the Asia Pacific and also the Latin America. So we decided to pursue the wholesale market because we believe that that was going to be our cutting edge strategic point in order to win the game. And so, as you can see, for the North America region and the Asia Pacific region, that we were able to dominate for as of year 20. Of course, for not the year, but for the Europe Asia region, we have Group F, which is the Fetch Footwear, and Latin America region, which was Group E. They were able to be predominant in this area for year 20, but we were satisfied with the overall position of our company because we was able to win at least 50% of the overall region as it relates to the wholesale market. So for our last table, which is table number 4, we're looking at the private label market. And for our company, it was very interesting that we would talk about private label because prior to year 15, we were emphasizing that we wanted to enter the private label so that we are able to be competitive in the game. But after year 15, we decided to exit the private label strategy just because, and as you can see for year 20, we did not have any presence in any regions for the private label. And we decided that we wanted to utilize the access capacity that we did receive due to purchasing from other companies and also from building capacity. We wanted to emphasize the wholesale market. So we realized that the private label was not going to really put us in a competitive win or in a competitive position within the game. So we decided to exit that strategy. You can see that Group H with just the whole shoes dominated the private label market. However, looking at it from the overall perspective of the game, Group H was not able to win within the top 3. So we were overall satisfied with not sticking with this specific market because it did not have a significant impact on our overall results. So throughout our competitor analysis, we're able to see that we decided to, if we were to move forward in the game in years 21 and 22, that we will want to continue with our current strategy, meaning that, for instance, with the internet market, we'll want to have use that as our second place competitive to push. So we want to increase and adjust our overall pricing by 5%, and of course continue with our overall models. With the wholesale market, we will want to allocate our nearly full inventory to the wholesale market because we realize that is where our customer base is coming from. And lastly, with the private label, again, as stated in table 4, though Group H has an overarching competitive advantage for us against us in that specific area, we'll want to stay absent or have very little influence in the private label. So we'll want to implement basically like we said before, our current strategy to move forward because we believe that will put us in a better position to, of course, be able to win the game. What we will decide to do different though is to focus a little bit more on the internet and a little bit more on the private label. But again, as stated before, with the private label, we do not want to have a heavy influence because it is not shown that it's going to have a significant impact on our financial results. Overall, we can say from the Bravo Footwear management team that we had an overall good experience, and we believe we had an effective strategy for wanting to compete successfully in this game. So our strategy as it relates to our game was to be able to pursue low cost, being able to go ahead and actually have a high models but low price, which of course allowed us to have low cost. our competitors basically wanted to do high price and pursue higher profit margins, but that was not our strategy. So being able to pursue that low cost strategy, allowing financially supportive, having buying back stocks and building plant capacity allowed us to be able to do a lot of things that we wanted to do in the company. So we are very pleased with our results.